Another technique in this regard is what we refer to as the contribution margin or contribution income technique. The contribution margin or marginal income technique. What does this technique say? The technique propounds the theory of contribution. Actually, by the time we take a lecture series on marginal and absorption costing, we'll have been much more acquainted with the terminology contribution. So, we say contribution per unit or unit contribution is equal to unit selling price minus unit variable expenses. In other words, the unit selling price minus the unit variable expenses equal to the unit contribution. Or we say that the contribution per unit is equals to selling price per unit minus variable cost per unit. Applying the contribution margin or marginal income technique to be able to get our BEP or break-even point, we say that BEP in units now is equal to fixed cost all over contribution per unit. So, whatever we get as a contribution per unit, don't forget, which is as a result of selling price per unit minus variable cost per unit. Whatever we get as that contribution per unit, we use it as a denominator to divide the fixed cost per unit. Then, whatever it results in is actually our BEP in unit. That is, the number of units we need to sell to be able to make a zero profit. Let's take back our former illustration on XYZ Nigerian Limited. Let's assume we are not aware of the 10,000 units which gives us a break-even point. All other factors are constant, all other factors are equal. The question says, calculate the level of activity or production volume at which the BEP or at which the profit will be equals to zero, or in other words, compute the break-even point. All other factors are constant. By saying that, I meant that the fixed cost is still 100,000 naira, the variable cost is still 5 naira. Okay, let's assume that there's an addition to that question. Let's assume that the fixed cost is 100,000 naira, the variable cost per unit is 5 naira, the selling price per unit is 9 naira. So, using the contribution margin or marginal income technique, what is the break-even point in unit? Now, don't forget we said in previous discussion that the BEP under this technique is actually fixed cost divided by the contribution per unit. Now, using this scenario or illustration, the first thing we need to get or ascertain is a contribution per unit. And what's that contribution per unit? The formula is selling price per unit minus variable cost per unit. So, and what is that? Our selling price per unit is 9 naira. Our variable cost per unit is 5 naira. By implication, our contribution per unit is 4 naira. So, we say, our contribution per unit is 4 naira, then, what is our break-even point? Break-even point is fixed cost all over contribution per unit. So we say, since we've been able to ascertain a contribution per unit, then we say fixed cost 100,000 naira divided by contribution per unit 4 naira will actually give us a break-even point in unit. So 100,000 naira divided by 4 naira gives us 25,000 units. So we say that at 25,000 units level of activity, there will neither be profit nor a loss. So this is referred to as the BEP in unit. So we are able to ascertain this using the contribution margin or marginal income technique. In other words, by implication, we could say that any sales below 25,000 naira will lead to a loss, while any sales above 25,000 naira will lead to a profit, while any sales at exact 25,000 naira will give us a zero profit, no loss and no gain. So I want to thank you for coming to this extent in this classroom. In a subsequent class, we did be looking at the formulas for computation of BEP. How BEP can be computed in units, which we have already expounded, and how it can be expressed in sales value or in monetary value. And also be looking at the concept of margin of safety.